Hello, welcome in our diploma courses 6th semester Mechanical Civil Project Management. Okay, I am Prashant Kumar Salwar with you. We have take today the unit 3rd, financial estimates and projections. Under this unit, cost of project means of financing estimates of scale, sales and production cost of production, working capital requirement and its financing, profitability, project cash flow statement and balance sheet, and last break even analysis. Okay, so we will deal with this financial estimates and projection. What is financial estimate projection? First of all, you do introduction here. Financial estimates and projections are essential for assessing the feasibility and viability of project. Means unless you have not decided that how much amount of the finance will require for your project, what you decide, so you cannot start with them. So first of all you have to decide whether how much financial burden will come, and they help the business determines the required investment, expected revenue, cost and profitability over the time. Means what is the cost to become and what will be the profitability for a whole project. Now, cost of project. The cost of the project, total cost of project include the three things: fixed cost, variable cost and other cost. Other cost means miscellaneous, whatever the you have included, which is not so pre-decided. Fixed cost means land, building, machinery, initial setup. These are the fixed cost. Variable cost, raw material, wages, utilities and other operational expenses which come regularly but it varies. That is a variable cost. And third one is the other cost, which is licensing, R&D, marketing, contingency, whatever the miscellaneous amount you have to cover, you drop in this cost, other cost. For example, a manufacturing unit require land and building 20 lakh rupees. Machineries you have put 15 lakh rupees. Initial working capital is 5 lakh you have taken with initially 5 lakh. So and total cost is in this way become the 40 lakh, because 20 plus 15 plus 5 is the 40 lakh. So total cost of the project is around 40 lakh. Means of financing means from where we have to accumulate this money. Means 40 lakh from where we can arrange. So this is the means of financing. Projects are funded through multiple sources of including equity capital, debt financing, government grant and subsidy and venture capital, yeah, angel investors. Okay, equity capital means this is when the project is so large you have to open the debentures issues or IPOs to the our the peoples to purchase them and make share on your project. This is a promoter's own investment. And debt finance means you have, whether you are taken loan directly, you have to take either loan from the bank or financial institution you have borrow. So this is the debt financing. And government grant and subsidy means whatever the amount you have can burden by the government, it is just like a subsidy or whatever the grant by the government. Venture capital or angel investor. Angel investor is venture capital or business professional who invest money into a startup on behalf of risk capital company. They are use other people's money. This is called venture capital. While angel investor are well off individuals who invest their own money in a start revenues, like Singhania, Ambani, like. And public issues of share for large corporation. For example, A project costing rupees 40 lakh, as earlier we have stated, may be financed as promoter equity 15 lakh, bank loan 20 lakh, government subsidy 5 lakh. Means from you have to arrange 40 lakh from promoters equity 15, bank loan 20, government subsidy 5. In this way whole the summation of this is become 40 lakh. Now, estimates of sales and production. Sales and production forecast help in planning resources efficiently. Estimation or estimates of sales and production is the sales and production forecast help in planning resources efficiently, and demand analysis, market survey and historical data are used for estimation. Key formulas: sales estimation formula, sales estimate is equal to number of unit expected to sell into selling price per unit. Okay. Production estimate formula, production estimate is equal to sales estimation plus desired ending inventory minus beginning inventory. Cost of goods sold, cost of goods sold is equal to beginning inventory plus purchase minus ending inventory. Beginning inventory and ending inventory, the actually the difference between these inventory shows that how much amount of part or you have invest in your particular production. Gross profit, gross profit means sales revenue minus COG, cost of goods sold. So this will simply you have expand and what you gain, the difference is called the gross profit. For example, we have taken the first question, sales estimation. A company expects to sell 5000 unit of a product at a selling price of rupees 20 per unit. So calculate the sales estimation. Sales estimate is equal to number of unit into selling price. Number of unit, how much number of unit here is 5000 unit, so put 5000 unit here into selling price. Selling price is set by the company is 20 per unit. You have put here 20, means sales estimate you have 1 lakh sales. Similarly, problem 2, production estimate. A company has the following data. Sales estimate already 10 set by company is 10,000 unit. Desired ending inventory is 2000 unit and beginning inventory is 1500 unit. Calculate the production estimate. We know that the production estimate is equal to sales estimate plus desired ending inventory minus beginning inventory, means difference of this is the 500, okay, plus 10,000 estimation. So they will give the answer 10,500 unit. Similarly, third problem, cost of goods sold. A company has the following data. Beginning inventory $5,000, purchase $15,000, ending inventory $3,000. So calculate the cost of goods sold. Cost of goods sold is equal to beginning inventory plus purchase minus ending. Put the values, 5,000 plus 15,000 minus 3,000, it gives the 17,000. Similarly, gross profit. A company has the following data. Sales revenue $50,000 and COGS $30,000. Calculate the gross profit. So we know that gross profit is equal to sales revenue minus COGS. Gross profit is equal to sales revenue minus COGS. Here 50,000 already you have the sales revenue, means you have gain, but you have already invested 30,000. Difference of this 20,000. This is the answer. Now cost of production. Cost of production means the cost of production includes direct cost, indirect cost. Direct cost means raw material and labor. Indirect cost, overhead, depreciation or maintenance. It affects the cost, but it is indirect. Therefore, it is called indirect cost. For example, a company produced 10,000 unit. Raw material cost per unit rupees 200 and labor cost of rupees 100. Overhead per unit is 50. So total cost will become 350. This is raw labor and overhead 200, 10, 100 and 50. It become 350. But company produced 10,000 units and these are all the per unit cost. So 350 into 10,000 will gives the 3,50,000 or T. Okay, 35 lakh. Now, working capital requirement and its financing. Working capital is the difference between current assets and current liabilities. It includes current assets and current liabilities. Assets and liabilities means what you have gained and what is you have to do. This is the assets and this is the liabilities. Current assets, cash, inventory, receivable, these are all your come in you, but you have to pay for this. This is short term loan and creditors. So this is your liabilities. Inventory, for example, inventory is 5 lakh, receivables rupees 3 lakh, and cash rupees 2 lakh, and payable rupees 4 lakh. So you have to decide in this factor which is your in your hand and what is your liabilities, what is your current assets and what is your liabilities. Here liabilities is only here is 4 lakh payable because it is receivable, it is a cash, your inventory already in your hand. So 5 plus 3 plus 2 minus 4 become 6 lakhs. Now working capital requirement, WCR is equal to the current assets minus current liabilities. Means actually when we have says here earlier current assets and current liabilities, so this is working capital and working liabilities means on spot what you have invest and what you gain. Current assets is cash, account receivable, inventory and other short term assets. Current liabilities, accounts payable, short term debt and other obligation due to within a year. And third is net working capital. Net working capital means total current assets minus total current liabilities. It is your net worth working capital and indicate liquidity and financial health. Means how much this is shows your how much sound you are, positive NWC and negative NWC. Means net worth capital may be positive or negative both, and it will judge the your health. Business can meet short term liabilities. In negative, business may face liquidity issues. And this is the term you should know, gross working capital. Gross working capital means total current assets and measure a firm total investment in short term asset. Gross working capital is measures a firm's total investment in short term assets. And operating cycle formula, operating cycle is equal to inventory holding period plus receivable collection period. Measure how long cash is tied up in working capital before generating revenue. And cost conversion cycle formula is CCC is equal to inventory days plus receivables days minus payable days, determining how long a company takes to convert investment in inventory into cash flow. Profitability projection. Profitability analysis help in evaluating the expected return on its investment. For example, if revenue is 50 lakh and cost is 35 lakh, so profit will become 15 lakh, difference of this. So profit margin is profit per revenue into 100. Profit is 15 per revenue, revenue is 50, 15 divided by 1500, 30%, it is a profitability projection. Now projected cash flow statement and balance sheet. Balance sheet means shows the balance between your gain and your loss, and this is a cash flow statement track cash inflow and outflow, whereas a balance sheet provide a snapshot of the company's financial position. Means how much you have gain and how much you have loss, or your liabilities, asset and liability. Between assets and liabilities shows the balance sheet. Projected cash flow statement in rupees lakh. For example, particular is opening a cash balance, amount is 2, cash inflow revenue is 50, whatever the rupees or dollar, whatever. So cash outflow is expense is 35 and closing cash balance is 17. Suppose this is the particular, this is the amount. Now we have to make a balance sheet, a projected balance sheet. So liabilities, you have to here take liabilities, amount, and assets of amount. Liabilities is equity, means you have to pay, repay. Loan, you have to repay. Profit is also is your liabilities, because it is a come from the your production sale. Assets, fixed assets, working capital, and cash means in your hand. So we have make it in this way a balance sheet. What is the break-even analysis? Break-even analysis is determine the point where the total revenue equal the total cost, means where we have not neither in losses nor gain, profit. So means our profit and loss is become nil. So formula is break-even point is fixed cost divided by selling price minus variable cost. For example, fixed cost is rupees 10 lakh, selling price is 500, and variable cost will 350. So what is the break-even point? Break-even point means fixed cost. Fixed cost means 10 lakh divided by selling price minus 350. So this way it is this unit. Actually, you for understanding the break-even chart, you have to show, you have seen here, this is the x-axis shows the monthly rental when, and this is the revenue monthly, y-axis shows the monthly revenue. Suppose this is the cost and this is the number of unit you sold. So what happened here, this is the fixed cost, red line shows the fixed cost, means this cost is whether you have start your production or not, but this will set, this is the fixed, this is land or machineries or whatever, and this is the variable cost and this is the variable cost, means vary, means when you have to produce this amount means here, then you have to neither in losses nor profit, and after this you will become in profit. So this is the profit line. So our production will start here, this is the profit line, this is the fixed cost, red line, total cost, this is the total cost, and this is the revenue, means you have gain. Okay, now taking a case study, suppose a XYZ Manufacturing Private Limited project overview. XYZ Private Limited plan to set up the manufacturing unit to produce consumer electronic item. The company conduct throughout market research and finds potential demand for 15,000 unit annually. Financial estimate, total project cost suppose 50 lakh, sales forecast 15,000 unit annually at the rate of 400 per unit, and cost of production is rupees 300 per unit, and break even point is 5,000 unit, and working capital requirement is 8 lakh. This is the scenario of about any company. Now in implementation plan means phase 1, first year companies do setting up the plant and acquiring necessary machinery, hiring skilled labor and operational staff, and third, producing an initial batch of product and conducting quality check. Second phase, companies doing in second year scaling production to meet market demand, expanding marketing and distribution channel, and optimizing production process to reduce the cost. And outcome is after 2 year XYZ Private Limited achieves stability and generate a net profit rupees 20 lakh. The company plan further expansion, increasing production company and exploring new market to sustain long term growth. So that was the actually a scenario of company. Now conclusion is financial estimates and projection are critical for making informed business decision. And proper planning help in securing funds, ensuring liquidity and maximization the profit. Okay, now taking the some question and answer. What are the key component of project cost estimates? Key component include capital expenditure, land, building, equipment, primarily and pre-operative expenses, working capital requirement and contingency cost. Question number 2, describe the primary means of financing a project. Answer is primary means include equity financing, owner fund, venture capital, debt financing, loan, bond, retain the earning, government grants and subsidy. Question number 3, why is estimating sales and production crucial for financial projection? Answer is accurate sales and production estimate are fundamental because they drive revenue projection, they determine the required production capital and associated cost, they impact working capital need and profitability, they are base of the projected cash flow statement. Question number is 4, what factor influence the cost of production estimate? Factor include raw material cost, labor cost, overhead cost, fixed and variable, production volume, technological contingent efficiency. Question number 5, what is the working capital and why is it financing important? Working capital is the difference between a company's current assets and current liabilities. Its financing is important because it ensures the company has sufficient fund to cover day-to-day operating expenses. It supports smooth production and sales. It maintain liquidity. Liquidity means in the currency form. How is profitability assessed in financing projection? Profitability is assessed through projected income statement, profit and loss account, calculation of key profitability ratio, for example, gross profit margin, net profit margin, return on investment, analysis of the break even point. Question number 7, what is the purpose of projected cash flow statement? Answer is the purpose of is to forecast the movement of cash into and out of the business over a specific period of time and identify the potential cash flow shortage and surpluses. Assess the company's ability to meet its financial obligations. Question number 8, what information does projected balance sheet provide? The projection sheet provide a snapshot of company assets, liabilities and equity at a future point in time and help assess the company's financial positions and stability. Question number 9, explain the concept of break-even analysis. Break-even analysis determine the point at which total revenue equal the total cost, both fixed and variable. It helps to determine the minimum sales volume required to avoid losses and start generating profit. Question number 10, what is the relationship between the mean of financing and projected balance sheet? Answer is the means of financing directly impact the balance sheet. Debt financing increase liabilities, equity financing increasing equity, and the balance sheet will shows how those financing method affect the company's assets and overall financial structure. Okay, I hope you enjoyed. Thank you.